Hello everyone, Alex Kim here. On Friday, January 30th, silver experienced one of the most violent single-day declines in its history, falling 26.44% in spot terms, losing $30.50 per ounce. Silver futures declined even more dramatically, down 31.37%, representing a loss greater than silver's entire value just 6 months prior. To put this in perspective, silver opened Friday morning at $121 and closed at $75. This wasn't a gradual repricing. This was mechanical liquidation on a scale that demands examination of the structural factors that created conditions for such a move. Gold fell 8.99% on the spot market to $4,893.59, with futures down 11.39%. Platinum dropped 17.2% to $2,150, and palladium declined 16.25% to $1,682. But silver's decline stood out both in magnitude and in what it reveals about how leverage interacts with positioning in a relatively small market. The ETF space amplified these moves dramatically. The iShares Silver Trust, ticker SLV, lost 31% of its value, while the leveraged ProShares Ultra Silver Fund cratered over 62%, demonstrating how derivative products magnify underlying volatility when forced liquidation occurs. This is not a retail story. Mining equities were hit disproportionately hard, with some names like Kerr Mining down 17%, though many silver-focused miners declined significantly more. The selling pressure in mining equities reveals that this wasn't just a futures market event, but a broad deleveraging across the entire silver complex. Equity markets showed modest declines, with the Dow Jones Industrial Average and S&P 500 both down 0.4%, while the Nasdaq fell 0.9%, indicating this was primarily a metal-specific liquidation event rather than broad risk-off sentiment across all assets. The catalyst cited in mainstream commentary was President Trump's nomination of Kevin Walsh as the next Federal Reserve Chair. Walsh, a former Fed governor who resigned in 2011 over disagreement with QE2 on inflationary grounds, was initially interpreted as a hard money advocate. That perception triggered dollar strength, which mechanically pressures dollar-denominated commodities. The dollar index, which had declined roughly 10% over the prior year, rallied approximately 1% on Friday following the Walsh announcement. A stronger dollar raises the cost of silver for foreign buyers, which contributed to selling pressure. However, deeper analysis of Walsh's more recent statements suggests his policy stance may be more dovish than the initial market reaction implied, potentially aligning with Trump's stated preference for lower interest rates. The market may reassess that view over the weekend, which could influence Monday's open. But the Walsh announcement was the narrative catalyst, not the structural driver. The primary force behind Friday's 26% decline in silver was mechanical liquidation triggered by cascading stop-loss orders across leveraged positions. This isn't speculation. This is positioning. Stop-loss orders are preset instructions to automatically sell a position if price falls below a specified level. These are ubiquitous among leverage traders using silver futures, contracts for difference, or margin accounts where position sizes exceed available capital by factors of 5, 10, or even 100 times. When price declines trigger one stop-loss, that forced sale pushes price lower, triggering the next stop-loss in sequence, creating a self-reinforcing cascade. During Friday's session, as silver began declining, initial stop-losses triggered forced selling, which accelerated price declines, triggering additional stops in a domino effect. Large institutional participants with visibility into where these stops are clustered can short into the market knowing that forced liquidation will drive prices lower, allowing them to cover positions at better levels. This dynamic creates conditions where relatively small initial selling pressure can trigger disproportionate price moves once the cascade begins, particularly in a market as concentrated and leveraged as silver. Following a parabolic rally where silver surged 135% in 2025, climbing from the 30s to over $120, positioning had become extremely crowded. Late-stage participants entering leveraged positions near recent highs had tight stop losses in place to protect against catastrophic losses. These hair-trigger stops created the structural conditions for Friday's liquidation event. As price broke through $100, a psychological level many assumed would hold as support, the cascade intensified, driving silver through $95, $90, $85s, and $80 before settling at $75. To assess what typically follows moves of this magnitude in silver specifically, I analyzed every single day decline of 5% or more in silver since 2000, when reliable data becomes available. This provided 26 years of data covering 96 instances where silver crashed 5% or more in a single session. This frequency alone tells you something critical about silver's character. While gold has experienced only about 10 such crashes over the same period, silver has experienced 96. Silver is structurally more volatile, which creates both risk and opportunity depending on positioning and time horizon. Following these 96 single-day crashes of 5% or more, the pattern is remarkably consistent. Silver was more likely to recover than to continue declining, and the probability of recovery increased significantly with time horizon. 7 days after a 5% crash, outcomes were mixed, roughly balanced between gains and losses as positioning reset. 30 days later, the balance began tilting toward recovery. But 1 year after these crashes, silver rose 56 times and fell only 32 times. That's a 64% probability of positive returns 1 year after a sharp single-day decline. The average gain for those 56 positive outcomes was 38%, significantly exceeding the magnitude of the initial declines. This doesn't mean Monday opens higher. It doesn't guarantee silver rebounds to $100 next month. What it establishes is that historically, sharp single-day crashes in silver have more often represented buying opportunities than signals of sustained downtrends, particularly for participants with time horizons measured in months rather than days. Panic selling creates oversold conditions that frequently reverse as positioning resets and fundamental buyers re-enter. The mechanical liquidation that drove Friday's decline doesn't reflect a change in silver's fundamental supply-demand balance. Silver has been in supply deficit for 5 consecutive years. Total cumulative deficit exceeds 800 million ounces, nearly a full year of global mine production that has been drawn from above-ground inventories. Industrial demand continues growing across every major application. Solar installations are scaling globally, each panel requiring silver for photovoltaic cells. Electric vehicle production is ramping across every major manufacturer, each vehicle containing significantly more silver than internal combustion equivalents. 5G infrastructure buildouts are accelerating, with each installation requiring silver for connectivity and conductivity. AI data centers consume silver in quantities that weren't part of demand models even 2 years ago. Defense applications are consuming silver at record rates for electronics, missiles, and radar systems. None of this demand is discretionary. Industrial users cannot substitute away from silver without significant performance degradation or cost increases that exceed silver's price. On the supply side, no major new discoveries have been made in years. Ore grades are declining at existing mines, meaning more earth must be moved to extract the same amount of silver. Lead times to bring new supply online exceed a decade even after discovery, which means current prices cannot stimulate meaningful supply response for years. Production costs are rising due to energy costs, labor costs, and declining ore quality. Mine supply cannot respond elastically to price signals the way paper supply can. These fundamentals didn't change on Friday. What changed was a paper price controlled by futures positioning and margin dynamics. Watch the flow, not the headlines. Physical market conditions remained tight despite paper price declines. Before Friday, mints including Perth Mint had suspended wholesale orders due to backlog. The U.S. Mint had halted Silver Eagle sales. Coin dealers were struggling with delivery defaults and liquidity constraints as detailed in previous analysis. Despite spot prices at $121, physical silver was difficult to source at any premium. Buyers were being turned away. Refineries were backlogged. Wholesalers had stopped purchasing from dealers. Now spot is at $75, but physical availability hasn't improved proportionally. Try buying physical silver today. Check dealer premiums over spot. Check inventory availability. The divergence between paper pricing and physical availability persists and has likely widened, reinforcing that futures-based price discovery and physical supply-demand operate on different timeframes and through entirely different mechanisms. Paper silver and physical silver are fundamentally different instruments. Paper contracts can be created through leverage with a keystroke. Paper positions can be liquidated through margin calls automatically. Paper markets are controlled by exchange rules that can be modified overnight to force selling. Physical silver cannot be printed, cannot be margin called, and exists independent of exchange infrastructure. When you hold physical metal, no exchange can force liquidation. No margin hike can confiscate it. The events of Friday demonstrate this distinction with absolute clarity. Are you seeing the same dynamics in platinum and palladium, or is silver's volatility and the scale of its decline reflecting something unique about how that market is structured and leveraged? If you find this breakdown useful, consider subscribing so you can track how these structural patterns develop. China continues accumulating physical silver while Western participants liquidate paper positions. Shanghai vaults drained 27 tons in a single day last week during the rally, with buyers taking physical delivery rather than trading contracts. This pattern hasn't reversed. While paper prices collapsed on Friday, physical buyers in Asia likely view lower prices as improved entry points rather than signals to liquidate. One side trades screens and gets stopped out mechanically. The other side loads trucks with metal and takes possession. The positioning contrast reveals which participants are managing long-term strategic allocation versus short-term price exposure. China controls 60% to 70% of global silver refining capacity. On January 1st, China classified silver as a strategic national security resource and implemented export controls. That policy decision wasn't made in anticipation of silver at $75. It was made when silver was climbing toward $120, and it reflects a view about silver's strategic value that extends beyond current pricing. If Chinese authorities believed silver was overvalued at $120, they wouldn't have implemented export controls. They would have exported aggressively to capture high prices. Instead, they restricted exports, signaling that domestic accumulation and strategic stockpiling takes priority over revenue maximization. That positioning hasn't changed because paper prices fell 26% in New York. The fundamental case supporting silver allocation hasn't been invalidated by Friday's price action. What changed was technical positioning and the mechanical liquidation that follows when leverage stops cascade through a concentrated market. Before Friday's crash, major banks were forecasting significantly higher silver prices. Citibank had forecast silver reaching $150 in 2026. Whether these institutions revise those targets following Friday's move remains to be seen, but the structural drivers they cited, industrial demand growth, supply deficits, monetary instability, and China's strategic positioning, haven't been disproved by a single day's forced liquidation. Silver doesn't move first. Stress does. The stress on Friday manifested through exchange-level mechanics and leverage dynamics, not through fundamental reassessment of silver's value proposition. Participants holding physical silver without leverage weren't forced to liquidate. Participants holding leveraged paper positions were. That distinction matters profoundly when interpreting what Friday's price action signals about underlying demand versus what it signals about positioning structure. The public narrative lags the positioning. Mainstream commentary will frame Friday as a bubble bursting or a correction following excessive speculation. That narrative ignores the mechanical reality that margin-driven liquidation can occur independently of fundamental value. It also ignores that silver's 135% gain in 2025 occurred during a period when industrial deficits widened, mine supply stagnated, and strategic buyers accelerated accumulation. Those conditions haven't reversed. Over the coming weeks, volatility will likely remain elevated as the market establishes a new range. Bid-ask spreads in physical markets have widened dramatically because dealers don't have clarity on where equilibrium pricing lies. Buyers will face premiums substantially above spot, potentially $10 to $20 per ounce over a $75 spot price. Sellers will receive discounts substantially below spot, potentially $5 to $10 below. This is normal behavior following extreme volatility events and will narrow as price stabilizes, but it confirms that physical and paper markets are operating on entirely different planes right now. For participants considering transactions in current conditions, scaling into positions gradually, rather than committing all at once, reduces regret, regardless of subsequent direction. For those already holding physical silver, Friday's move doesn't alter the original thesis, unless that thesis was predicated on uninterrupted upward momentum, rather than structural fundamentals around supply deficits and industrial demand growth. Volatility is a structural feature of silver markets due to the embedded leverage and relatively small market size compared to the capital that can flow in and out. The question isn't whether volatility occurs, but whether the underlying fundamentals supporting allocation have changed. Based on available evidence, they haven't. What changed was technical positioning and the forced liquidation that follows when stops cascade. Historical precedent from the 96 prior instances of 5% single-day declines suggests patience has been rewarded 64% of the time over one-year horizons, with average gains of 38% for those positive outcomes. That doesn't guarantee this instance follows the same pattern, but it establishes the base rate probability. Whether Friday represents a correction within an ongoing bull trend or the beginning of a sustained reversal will become clear over coming weeks as positioning resets and participants reassess risk-reward at new levels. For now, the data suggests sharp single-day declines in silver have historically been absorbed and reversed more often than they've marked the end of structural trends. The intensity of Friday's move, 26% in a single session, reflects the violence that occurs when leverage unwinds in a concentrated market. But violence in unwinding doesn't invalidate the fundamental case. It reveals that too many participants were positioned the same way, with too much leverage and insufficient margin to withstand even modest adverse moves. Those participants have now been cleared out. Accounts have been liquidated. Stops have been triggered. The leveraged weak hands are gone. What remains are physical holders who cannot be margin called and strategic buyers who view lower prices as opportunity rather than risk. That shift in participant composition may be the most structurally significant outcome of Friday's session. Markets climb walls of worry, and corrections are structural features of bull trends, not disproofs of them. Silver's 135% gain in 2025 was never going to proceed without violent setbacks. The question is whether Friday's setback reflects the end of the move or a reset that clears positioning for the next leg. History suggests the latter is more probable, but probability isn't certainty. Participants must assess their own time horizons, risk tolerance, and whether their positioning can withstand further volatility if it occurs. For those with conviction in the fundamental case around supply deficits, industrial demand, and strategic accumulation, Friday's price action doesn't change the structural imbalance between above-ground inventory and growing consumption. For those who entered late with leverage near $120, Friday likely ended their participation regardless of what happens next. That's the difference between holding physical assets and trading leveraged paper. One survives volatility. The other gets liquidated by it. How do you interpret the divergence between 26% paper liquidation and persistent physical tightness? And what does that tell you about where the real marginal buyer is positioned going forward? Share your thoughts below, and I'll continue monitoring how this repositioning develops across both paper and physical silver markets.